Let's say you want to buy a house. You've been living on 2-minute noodles for a couple of years to save a deposit. While everyone else has been out there eating their smashed over on toast for breakfast, you've been eating cornflakes. But even after all that saving, you still have less than 20% of the deposit. Property prices are going up, and it seems like you're barely keeping pace with the increased deposit requirements. The dream of owning a home is slowly fading away. But then, a bank in shining armor comes to the rescue. They'll gladly lend you 95% of the value of the home with one small catch. All you need to do is pay them a little something called lender's mortgage insurance, or LMI. It's going to cost you just a little bit of extra money, but no big deal. You can just add that to the cost of your mortgage and pay it off along with the home. And after all, if it's insurance, then it's somehow a good thing, right? Wrong, very wrong. Lender's mortgage insurance is like a friend who's an enemy at the same time. A frenemy. Sometimes it's sweet and sometimes it bites. If you're a first home buyer, you need to understand what LMI is, how it works, and how you might end up losing your home and owing tens of thousands of dollars to an insurance company. This happened to Helen and Joe Tolan. They unfortunately defaulted on their loan, but they had LMI, so no big deal, or so you'd think. At the end of the process, they discovered they owed $87,000 to QBE LMI. They've spent almost a decade paying back this money and they've got nothing to show for it. So in this video, we're going to take you through a deep dive into LMI, what it is, who it protects, and how you can avoid ending up in a situation like Helen and Joe. But first, be sure to subscribe to our channel to get regular updates and information on the home buying process. And let me know in the comment below what you think of this video. We really appreciate your support. So LMI, or rather LMY, why would you pay lender's mortgage insurance? Lender's mortgage insurance helps in that it allows you to buy a home with less than 20% deposit, and sometimes as little as between 5 to 8%. Here's how it works. Banks and lenders consider any home loan with a loan to value ratio higher than 80% to be a higher risk of defaulting. So in other words, if you've got less than 20% deposit, the banks are going to make you pay the lender's mortgage insurance to reduce the risk. Lender's mortgage insurance comes into play when you default on your mortgage. The bank repossesses it and your property sells for less than the amount owed on your home loan. Unfortunately, in this case, the insurer will pay the bank for any money they're out of pocket. So in other words, you pay the LMI to protect the bank in case you default on the loan. Yeah, you heard correctly. LMI protects the bank, not you. And let me repeat that. If you're going to take away the one thing from this video, it is this. LMI only is there to protect the bank. It doesn't protect you, the property owner, at all. And if that's a surprise to you, you're not alone. According to a recent survey, 8% of households thought that LMI protected them rather than the bank, and almost 18% assumed that it protects both the bank and the borrower. And it's incredibly disturbing, especially since the lender's mortgage insurance can run into tens of thousands of dollars. You can check it out a lender's mortgage insurance calculator on the website. If you're buying a $600,000 home with a 10% deposit, you'll pay around $10,000 in lender's mortgage insurance. And that's only the cost if you pay all the lender's mortgage insurance up front. If you add the lender's mortgage insurance onto your loan, which is pretty common, they call it capitalizing the lender's mortgage insurance, you'll be paying interest on it too over the life of the loan. So for example, paying that extra $10,000 in lender's mortgage insurance may cost you an extra $46,625 in interest over the 30-year life of the loan. Think that's bad? Yeah, kind of gets worse. If your mortgage defaults and the sale price of the house doesn't cover what you owe to the bank, the insurer will pay out the difference to your lender. But, and here's the thing that most people don't realize, the insurer is legally entitled to come after you to recoup the money they've paid out. And that's exactly what happened to the Tolans. Their repossessed home sold at a loss. QBE paid out the lender and then wanted the repayment of $87,000 off the Tolans. The couple only avoided bankruptcy by going into a debt agreement to pay back the cash, which crippled them financially. The couple expects to pay off their debt next year, almost a decade after they defaulted. And unfortunately, this isn't a one-off situation. Nearly 5 years ago, an ABC investigation found that dozens of struggling home buyers were forced into bankruptcy over LMI policies. More than 1/4 of borrowing households take out LMI. And really today, that number continues to increase more and more as properties get more expensive. In fact, data from Digital Financial Analysis shows the number of LMI policies taken out in Australia rose by 25% from 218,000 in 2019 to 273,000 in 2020. That's over 250,000 households per year that are putting them at risk at bankruptcy if they default on the home loan. And that's if you miss your repayment on your home loan. So is LMI a complete and utter scam? Is it something you should avoid at all costs? Well, not quite. Despite its flaws, LMI still plays a really valuable role in the home loan ecosystem. Remember that LMI is designed to lower the risk for banks and lenders, so they're more willing to lend to you if you've got less than a 20% deposit. And considering the current trends in the market, saving up a 20% deposit could mean years of extra saving before you're able to buy, or in the current market, possibly never at all. So realistically, LMI is a useful tool as long as you're aware of the risks and who it protects. I've mentioned this earlier in the video, but I really want to repeat it again, so it's important. LMI only protects the bank, not you. So as long as you're aware of that and you're confident that you're not at risk of defaulting a loan, then it's perfectly reasonable to use LMI to get into the market. And the good news is, in some cases, you can buy a home with less than a 20% deposit without needing LMI at all. That's if you meet certain criteria. You may be able to have the lender's mortgage insurance waived. There are 5 different ways you can get the lender's mortgage insurance waiver. First, if you qualify for the first home loan deposit scheme, you may be able to have your LMI waived when you're buying your first home. We've got a bunch of other videos on this scheme. If you want more info, hit us up for a free assessment at huntergalloway.com.au. The downside to this scheme is you need to bear in mind that the number of slots are limited each year to only 15,000 to only $10,000 each financial year. The next way to avoid lender's mortgage insurance is using the Family Home Guarantee Scheme. It's similar to the first home loan deposit scheme, except in this case, it lets you buy with as little as 2% deposit if you're a single parent. Similar to the first home loan deposit scheme, it allows the government to act as your guarantor and avoid paying lender's mortgage insurance while potentially borrowing up to 90% of the value of the property. Pretty wild. The third option is for some job types, and I guess the banks consider them professionals. If you're a lawyer or a doctor or an accountant, or oddly even an athlete, or entertainment professional, then the lender may offer you a no lender's mortgage insurance loan. But there are some pretty strict criteria around this with each profession. Different banks have income hurdles. You need to be members of certain associations if you're an accountant. If you want to know more info on this, hit us up at huntergalloway.com.au or give us a call and we'll give you a rundown to see if you're eligible to have your lender's mortgage insurance waived. The fourth option is something that's only become available pretty recently, and there's a few lenders out there that are doing 15% no lender's mortgage insurance loans if you're a first home buyer or if you're buying a home to live in. It's pretty awesome. It means you can put in 5% less deposit and get there a bit sooner without having to pay the lender's mortgage insurance. At the moment, the lenders that do this are St. George and 86400. It's an online bank owned by NAB. If you want more info on this, again, hit us up. We can check it out for you and see if you're eligible. The last way of avoiding lender's mortgage insurance is through a guarantor loan. This is someone that's generally a direct relative. Now we have a whole other video on guarantor loans. In short, the bank would put effectively 80% of the loan against your property, 20% against your parents, generally the guarantor's property, and in effect lend you 100%, avoiding lender's mortgage insurance. There's a bunch of different criteria on this. Generally, the banks prefer it if your parents are working, not retired, their property needs to be in Australia, etc., etc. Check out the details on our guarantor video below to go through that. But if you don't have a 20% deposit and you don't qualify for any of the LMI waivers I mentioned before, then you still might be able to save on reducing your LMI premium. Here's how. If you can, try and aim for the lowest loan to value ratio as possible. The higher the LVR, the lower your deposit, the higher the premiums. So for example, if you're buying a $700,000 property with a 95% LVR, then the LMI costs are $31,044. If you manage to save an extra 5%, it reduces the lender's mortgage insurance premium to $17,200, almost halved. Now, it's not always easy to do this. Saving the extra deposit isn't feasible or you don't want to wait, then you could always look at switching to a different lender to reduce the LMI cost. LMI costs do vary between banks and lenders, and in some cases by thousands of dollars. We managed to save $6,000 for one of our clients simply by switching to a different lender who had a cheaper lender's mortgage insurance rate. Pretty cool. We've got a bunch more in our article before. Like I said, check out the LMI calculator. So wrapping up, for LMI, remember firstly, it protects the bank, not you. If you want some protection, potentially look at income protection or something else through a financial planner. If you want to add LMI to the base of your loan, you're potentially going to be paying interest on the loan and the LMI over the next 30 years, so it could increase the costs. Remember, the scenarios we spoke about before with the lender's mortgage insurance are only in the case of you defaulting on your loan. If you don't miss your repayment, if you don't default on your loan, then the bank's not going to kick you out realistically. It's just something to be aware of that it could cost you tens of thousands of dollars in a worst case scenario. So what did you think? Have you paid LMI? Are you thinking about avoiding it? Are you trying to save? Let me know in the comments below. We'd love to hear from you. And if you need any help with finance or home loans, Hunter Galloway are the mortgage brokers for home buyers across Australia. Hit us up at huntergalloway.com.au. And until next time, see you later.